our lecturer and my fellow friends. Okay, do you know what's the meaning of a journal entry? Okay, let me explain about it. A journal entry is a record of the business transaction in the accounting books of a business. A properly documented journal entry consists of the correct date, amounts to be debited and credited, description of the transaction, and a unique reference number. A journal entry is the first step in the accounting cycle. The journal details all financial transactions of a business and makes a note of the accounts that are affected. Since most businesses use a double entry accounting system, every financial transaction impacts at least two accounts, while one account is debited and another account is credited. This means that a journal entry has equal debit and credit amounts. The logic behind a journal entry is to record every business transaction in at least two places, known as double entry accounting. For example, when you generate a sale for a cash, this increases both the revenue account and the cash account. Or if you buy goods on account, this increases both the account payable account and the inventory account. That's all from me. Thank you.
Assalamualaikum and hi, my name is Nur Atira binti Muhammad Samsudin. My matric number is 269792. I will talk about unadjusted and adjusted trial balance. A trial balance contains all the accounts in the ledger of a certain business. The list of accounts may contain assets and liabilities as well as revenues and expenses. An adjusted trial balance is one that presents the total listing of all the account balance and titles in the ledger after all the adjustments have been made in a certain period. On the other hand, it is a wise step to always use an adjusted trial balance, especially after posting of the accounting transaction in a month. This way, errors can be easily detected on both sides between the debit column and the credit column. These two kinds of trial balance are both pertinent to auditors and accounts alike. They are both necessary for the imbalance reporting during the end of period processing. But no matter how important their roles are, there are still some differences seen between the unadjusted and adjusted trial balance. Some of the common differences are following. The first difference is that by the term itself, the adjusted trial balance is the end product or the final balance after all the adjustments have been made. Unlike in the unadjusted kind, the entries are not final yet. Rather, the entries may be balancing entries, accurate revenues, depreciation, and even expenses. Second difference we might consider is that the adjusted trial balance is usually used before all the journal entries were entered. Therefore, no adjustments were taken. Meanwhile, an adjusted trial balance is one wherein all the necessary adjustments of the journal entries were already made, so that there is a balance between the two sides, the credit and the debit. Lastly, the adjusted trial balance shows the net or loss of income as part of an additional account. The generalized the report of the account. The adjusted kind will simply enter all the necessary figures.
My name is Fung Siman and my matric number is 269726. A proper set of financial statements, which are statements of profit or loss, statement of change in equity, and statements of financial positions are useful in managing a company. Financial statements represent a formal record of the financial activities of an entity. These are written reports that quantify the financial performance, strength, and liquidity of a company. Financial statements reflect the financial effect of business transactions and events on the entity. Statements of profits or loss reports the company financial performance in terms of net profit or net loss over a specific period. Statement of profit or loss is composed of the two elements, which is income and expense. Income is is what the business has earned over a period, for example, sales revenue, dividend income, and many more. While expense is the cost that incur over a period, for example, salaries and wages, depreciation, rental charges, and many more. Net profit and loss is arrived by deducting expenses from income. Statements of profit or loss is important because it clearly states whether a company is making a profit. The total revenue and expenses of a company are listed on its statement of profit or loss. The account has not been adjusted at 31st December of 2019. The possible adjusting entries might be necessary before an accurate set of financial statements could prepare include prepaid expenses. Prepaid expenses are the advance payment of future expenses and are recorded as asset when cash is paid. Examples of prepaid expenses include prepaid insurance, prepaid advertising, and prepaid interest. Besides that, unearned revenue are the advance receipt of future revenues or cash received in advance of providing services or products to customers. Hence, they are recorded as liabilities when cash is received because a business has an obligation to provide services or products in the future. Examples of unearned revenue include tuitions received in advance by a school, an annual retainer fee received by an entity, premiums received in advance by an insurance company, and magazine subscriptions received in advance by a publisher. Moreover, accrued revenues. Accrued revenues are unrecorded revenues that have been earned and for which cash has yet to be received. Examples of accrued revenues include accrued interest on notes receivable and accrued rent on property rentals from others. Not only that, accrued expenses also have been one of the adjusting entries. Accrued expenses are unrecorded expenses that have been incurred and for which cash has yet to be paid. Examples of accrued expenses include accrued interest on notes payable and accrued taxes. Lastly, depreciation expense. Depreciation is all fixed assets, except land, lost their usefulness. As time passes, the equipment loses its ability to provide useful services. That's all from me. Thank you.
Assalamualaikum, my name is Nur Aiman Syami bin Shu'aib. My matric number is 269912. The fourth one is financial statement of changes in equity. It shows the change in an owner or shareholder's equity throughout an accounting period. It is also called the statement of retained earnings. It details the movement of reserves that make up the shareholder's equity. It is important because it can allow analysis and reviewers of financial statement to see what factors cause a change in owner equity during the accounting period. Lastly is statement of financial position. Most often are called balance sheet. However, when a company is a government or non-profit organization, the original term statement of financial position is used. It helps users of financial statement to assess the financial health of an entity. It is important in determining the state of entity liquidity risk, financial risk, credit risk, and business risk. Financial statements help companies make informed decisions since they highlight which areas of the company provide the best return on investment.